Hot off the presses, a new print of CPI from the Bureau of Labor and Statistics. We're going to look at exactly where inflation is, where it might be going, how that's going to affect interest rates, the economy, and of course, commercial real estate in the multifamily market. Some other really interesting reports here that we're going to discuss on the Gray Report. One from MSCI, inflating returns with private lending and subscription lines of credit. If you're not familiar with subscription lines, we're going to dig into it a little bit and how that affects returns from Apartment List, their national rent report for December 2024, and then the 2024 Viewpoint Report from Integra Realty Resources. Exciting report. You're going to want to stick around. So if you're a multifamily investor, active, passive, somewhere in the middle, you're in the industry, you're in the right spot. Every single week on the Gray Report, we're breaking down all the latest reports, data, and some original insights from the Gray Capital team. I'm joined by Dr. Bosnagel, Director of Communications and Marketing here at Gray Capital. Let's get into it. Welcome back to the report. Matt, how's it going?
Pretty good. Pretty good. I feel like I'm a little bit more on top of things this week.
Oh, good.
Last week I was behind, but today I'm ahead, so it all evens out.
That's good.
You're back. That's what I feel so great.
See, yeah, back in the saddle.
That's right.
Back in
most of the person for sure.
Yeah, nice to see you as well. Matt, came on an interesting day because we got a new report, new print of CPI that came out a little bit hotter than most expected. Again, it's almost a joke because we're always talking every 3 weeks. It's like we're going to be, rates are coming down, rates are going to stay where they are. Everyone was convinced that we were going to see extremely low interest, or we were going to see significant drops throughout 2023. Throughout 2024, I keep being reminded that we're in 2024. And, you know, are we actually ready as an economy to see some of the Fed funds rate be decreased from Jerome Powell? On one hand, the economy, you know, is in pretty good shape. It's robust. It's really withstood a lot of challenges, much stronger than most people would think. You know, it just brushed past recession calls, all kinds of turbulence. But there's also a lot of evidence saying that the economy is slowing down. Maybe it's normalizing. We keep getting these jobs numbers, which come out strong, but then they keep getting reported, revised downward. I think in 11 of the past 12 jobs reports have been revised downward, I think on an average of 40,000 jobs. So, you know, there is some easing. Maybe that's healthy. Maybe that's normalizing. But, you know, let's just jump into the CPI report. And Matt, just want to get your takeaways. And you've done a whole piece on it. Written a bunch of notes. Well, I have not. What do you think?
Yeah, like, so I have like a larger context for like the CPI, inflation, interest rates, and that kind of narrative, because the implications for multifamily investors is like, all right, is this going to make it easier or harder to invest?
Am I going to be able to refinance that loan? Or am I going to be able to buy that rate cap? Am I going to be able to buy that deal? You know, or am I going to be able to sell that deal? And all of that is dependent on where rates are.
And so and if newsletter subscribers will have a drier kind of paragraph on the same topic. But
what newsletter are you talking about?
Oh, this is the Gray Capital newsletter. And if you'd like to subscribe, just go to graycapitalllc.com/newsletter, and you'll get it for free every week. It's amazing. But also, it has formed a lot of what I was thinking. So last night, as I was making the newsletter, I was thinking a lot about the idea of timing and kind of the time value of money. And there is this tension, basically, that is continuing to build as interest rates remain elevated, as capital markets remain essentially frozen, and there is little possibility of rent growth increases that may provide relief to multifamily borrowers that are facing loan maturities.
I guess it depends on which market you're talking about, though, right?
Yeah. And it does, you know, it is definitely different between like a Sunbelt market or, you know, or like Chicago or something. But there are still, it is a non-zero amount. May not be a wall, maybe a wave of loan maturities. I don't know, but there's stress in the market right now.
Or the wave.
Yeah. And my point is not necessarily that disaster from loan maturities is coming, but it is more like, what are the tools that people are going to use to relieve this tension? And I think that part of it is to kind of extend the period with things like what you mentioned before, these subscription lines of credit, private lending, and I want to know a little bit what the fall on results of that could be. So, we're looking, okay, loan maturities are coming, interest rates are high. What's some kind of Band-Aid solution? Well, you can get some private lending, kind of non-bank lending solution, and maybe pay a little bit higher, but you'll be able to survive a little bit longer. So what happens after that survival is just kind of interesting to think about, and there is some commentary here this week about it. Now, the other tension is that there's a lot of this pent up demand from these from these capital markets. Now, people talk about dry powder as though it'll like swoop in and completely change the market. But I think that I just want to prime our discussion of the CPI with a few lines from the Integra Realty Real Sources Viewpoint report. So he says, quote, "Those who over-leveraged or who cannot deliver exceptional management will run out of time and will represent the opportunities that the dry powder crowd has been waiting to meet. The coming year will be a career-making lesson in the value of liquidity and the time value of money." So that's it. Time, money, 2024. I'm here for it. Let's talk about CPI.
There we go. That's a good transition, and I think it's true. Let's go. Okay, looking at the consumer price index, Matt, came in just again a little bit hotter than most folks expected. Came in right at 3.4%. It was anticipated was 3.1 or 3.2. Matt, that was the expectation.
I don't know what the expectation was.
Yeah,
I didn't.
It was.
Yeah. So, but it definitely was a slightly higher than what was expected.
And so, how are they going to lower rates in March if inflation is up?
That's what my question was. I was like, okay. So, how many rate cuts were markets expecting? 6, 11, 12? I don't know.
3, but
I'm looking closer to that 3 than and I think that at the bottom of their hearts, those really excited people, they knew maybe that they were getting ahead of themselves by predicting more rate cuts. But I thought that this inflation report was interesting as in the way that it's kind of reported, even in their summary itself. And they do mention, which good for them, they mention energy prices and food prices, but they also mention shelter. And I don't think that the culprit for the raise in inflation is shelter as much as it was the rise in gas prices. So just for the raw numbers, you mentioned that the all items inflation was 3.4%. That's a little bit higher than the 3.1% annual increase that we saw in November. Now, the monthly number of November, 0.1% increase. The monthly number for all items in December, 0.3%. So a pretty significant jump. But for core inflation, which excludes food and energy, prices went down from 4% year-over-year price growth in November to 3.9% in December. So that's good news. Really, if you do exclude those things, then inflation looks a little bit more stable and really decreasing. Now, to talk about these drivers, again, they mention shelter as a driver, but I don't really see it as clearly as maybe the headlines do, because yes, overall housing prices are up. But the 5% increase in overall shelter is not much more than the 0.5% increase last month in overall shelter. That's not that much more than the 0.3% increase for all items. And shelter inflation actually was a little bit lower in November than in December than it was in November. So it's not like there's a sudden surge in housing costs. And just to kind of close the loop here, for rents specifically, the growth in rent prices has continued to level off from a 0.5 increase in November monthly to a 0.4 monthly increase in December. So the year-over-year numbers, shelter 6.2 compared to 6.5 in November, going down. Year-over-year rent.
But that's just 6.2%. We all know that's like when every other rent tracker were negative rent growth.
Yeah, and exactly. And so
it's not we're talking about like there's a little bit of a difference, but we're talking 7 percentage points spread.
And the movement is clearly inflation's going down. Whether it is
true. And we talked about it's more of like what direction are we headed?
Yeah.
The numbers could be right or wrong.
Raw numbers on the snapshot. Yes, a lot of it from a snapshot perspective, shelter does take responsibility for a lot of the inflation numbers that we're seeing. But from a trends perspective, no, the thing that changed was gas prices. So energy, energy followed the same path. We had several months, and I'm looking at gas prices because those are more dramatic, month after month after month of 5 or 6% decreases for gas prices. And that's, those are compounding. So there's even more. And now we're actually at a relatively normal 0.2% increase for energy and 0.2 increase for gas and 0.4 increase for energy. So they're kind of like back to normal. Yeah. But that difference between the huge negative numbers and the normal numbers, I think that's largely responsible for the uptick in inflation. So I don't know if you remember, but I certainly do, that we mentioned on this very podcast that those several months of energy price reductions were probably going to come to an end. And we definitely did, and it feels great. Feels great knowing we made the good call.
Did we did all right?
Well, I think we did. And I think it feels even better knowing that other people know, and then knowing you're coming to the right place for the best information and insights on multifamily and the economy.
I think we've been building a pretty decent track record of being on top of it.
Yeah, I mean, I'm willing to be wrong, and I definitely also respect, and you'll see this in some of these reports, and we talked about it too from that Cushman and Wakefield report last week. I like when people lay a claim and kind of say something definitively. This is going to happen or this isn't going to happen. Mm-hmm. Even if they're wrong, I respect that more than here's something that could happen and here's another thing that could happen. That's no fun. So I'm not gonna be scared of being wrong, but I sure do like being right.
No, I heard an interesting call today, very definitive, very optimistic call. I was on a meeting. I'm on the Indiana University real estate advisory board, and there was a professor from the Kelley School of Business, economist, talking about his outlook on the economy, and he was very optimistic, basically saying that the economy has been quite resilient, and we were really setting ourselves up for an extended period of strong growth. Now, I think there could be some wrenches thrown into the gears. Obviously there can be some black swans, but needing to see through some of the pessimism and just the cloudiness that we've been living in since COVID. Yeah. But we're really kind of getting to this tail end of kind of this COVID period and getting into a period of normalization, and we can really start rocking forward. And, part of it is, labor productivity has been increasing for the last 2 years in a really positive way. Yeah. And, as interest rates go down, there's going to be more business activity. And his big call was, as soon as the Fed once the Fed really actually lowers interest rates, we're going to see, or his opinion was, we're going to see a release of pent-up demand and a ton of demand. And he was saying, if I owned a business, I would be ready to serve that demand. Yeah. And part of me is like, does the average consumer, are they even tied into the fact of, where the Fed funds rate is? And they're not listening to, Jay Powell.
Home mortgages, I guess.
Exactly. Yeah. It does trickle through the economy. And we saw it 18 months ago when they started raising interest rates. Yeah. We saw that psychology of like, things are getting bad. I can't make any decisions. I'm going to put off all those big decisions. Yeah. Because I can't commit to anything right now. And so we're approaching that period, this is his opinion, I don't disagree with, of there being a little bit more clarity on the future and an idea of things are getting better. I mean, we're going down the hill versus climbing up the hill, and or we're cresting. We're about to crest. Yeah. And as we start to slide down the hill, that's going to really bring or allow that demand to be unleashed that's been pent up. Yeah. That's going to include, rent, the demand for housing of all sorts, more GDP growth, and it's going to hopefully, backstop anything else negative that happens in the economy. So I think there's a lot to be hopeful for.
And just a little bit of, a couple of data points that would support this IU professor's, his claims here is that people's opinions, and this is based on kind of surveys, but people's opinions that inflation is actually coming down, that's actually starting to bubble up in the survey results.
Yeah,
and
people are understanding that. Yeah.
And similarly, the Fannie Mae Home Sentiment Survey, it is at a record high that people think that interest rates are coming down. So, and this is not just a record high for the past 3 years. It's for however long they've run that survey, and I think that's pretty significant. I think that represents a amount of optimism that may be clouded when people are asked about the economy, because they're like, well, who's president? Okay. Now I know what I think about the economy, but like
exactly.
There are definitely signs, I think, that sentiment's coming around, and I wasn't even expecting to see them, because I think I was so ready to see. People have been so pessimistic for so long, illogically so, and I always thought
illogically and logically. I think there were a lot of good reasons to point to a recession earlier this year and now, but the fact and the data are what they are. And that the consumer has been more resilient. We have been pushing things forward. As much as we joke about it, AI and artificial intelligence and technology in general is going to continue to make us more productive as a society. We're going to be able to produce more with less. I think we've got a lot of good things that are going to be coming in the next 5 years. Not that there's going to be a lot of trouble and some bumps in the road that we got to work through, but right now, I guess, the sentiment is it's time to take a risk on stance and make some moves and get out there, as everyone's been living under a rock the last, year or two.
Yeah. I think it's hard to shake off things like inflation. They want the price to come down. They don't want the price growth to come down. But I think people's anchors are slowly shifting and they're kind of getting used to it. But
I traveling this last week or so, Matt, prices are higher. Oh my gosh. I was at the airport. Now airport food's always expensive. I was flying to the airport yesterday. The restaurants in general, it is insane. I mean, the hotels. I guess it's the world we're living in.
Can you pull up what the like food away from home cost price is? That would be in that table, this detailed table, and it is. I'd love to know because I feel like restaurant costs have gone up so much. And maybe it's because when you swipe you got to swipe when you swipe your card, you're asked for that 30 to 50% tip. But
we don't need. I don't even want to get into all the times you're asked for a tip. That's unnecessary.
I will say, if I had that and I was the cashier, I would put it. I would program.
Every business, why not? You don't have to do it. Everyone's like, oh,
I know.
Everyone's clicking the button.
You gotta, and that's what I also would do if I was the cashier, as I would look them in the eyes as they tap, and then I would know.
Okay, you could also do the opposite. You could look them in the eyes and press 0.
Yeah, that's true. That's a power.
All depends. And again, like I'm a big tipper. Like I really like the tip. I mean, in COVID especially. I was 25, 30% sometimes. It's like I'm just want you guys to stay in business. If I go places, I think it's a win-win scenario if you're at a hotel. I mean, you should start tipping everybody. They're working hard.
Personless kiosks that'll ask you for
exactly. It's like, and I'm like, who am I tipping here? I'm like, are you receiving this? Is the machine receiving this? But Matt, food away from home, we're up about 5%, 4.87 year over year.
Feels like more.
0.3. It does feel like more, but who knows how they're I mean, they're probably not. They're not calculating the tips. How do they even? If it's anything like how they're calculating shelter, there could be some questions.
Yeah, that's true. Long and variable lags.
Long and variable lags, and also we're just going off our anecdotes. But okay, Matt, you want to hop into this MSCI piece, inflation returns to subscription lines of credit, which this is an interesting piece, and it's a good topic that I don't hear people talk about as much, but it's really important, especially if you're a limited partner and you're thinking about investing, especially in funds, not necessarily in like in deal by deals, but especially in funds. And you were asking me earlier today when we were doing a little bit of prep for the call, Matt, and you were like, I need to know a little bit more about these subscription lines of credit, like exactly what they are, what they do, like they seem like. I don't know, especially the way that the article is pushing it as that could be a negative thing potentially. And I think I told you they're a tool.
That's what
you know, and they could be used a variety of different ways, just like leverage is a tool. And in a way, it's sort of another form of leverage.
Well, and that's what my thought was when
Can I tell you what they are?
Oh, yeah. Tell me what they are.
the listeners.
Yeah.
So a subscription line of credit. So let's say you have a fund, okay? And you're raising money from people. And you're going to go out and buy, well, let's say you're buying let's say you're buying single family homes. You're going to go raise $100 million, and you're going to go buy, I don't know how many homes would that be? Hundreds of homes, maybe 1,000 homes. You're not, but you need money each time you buy a home, right? So you've raised money from these investors in the fund. They've committed to providing capital, and you have to give them a notice. No one wants to have to send money once a month, maybe even once a quarter. That's a lot of transactions for the investor to send their capital into that fund manager, to that account. Does that make sense?
Yeah, but why don't you just collect it in a lump?
Because they're not ready for all the money. Because as soon as they receive the capital, as soon as the GP, the fund receives the capital, the clock starts running on the accrual, the preferred return accrual specifically, and also like the beginning of the investment. So instead of calling all your capital up front before you do all the deals and you're sitting on a bunch of cash, which you didn't have to pay a return on, but it's dead equity. It's just sitting there. It's not earning a return. What a lot of groups do is they'll get all their subscriptions. So you when you're investing in something, whether it's a syndication or a fund, you sign a subscription, you fill out a subscription agreement. And that's, I'm basically subscribing to the company. I'm signing the operating agreement, and there's a disclosure of, I'm not laundering money, and I'm not a terrorist, and I am who I say I am, and I'm an accredited, all that stuff. And here's my name, is where the money's sent, my address, all EIN, social security number, that stuff. But it's a more or less it's an agreement, it's a contract. So you can, instead of saying, okay, now send me your money and I'm going to sit on it for 6 months until I find the deal. Instead of what you could do is you take those subscriptions and you can use those subscription agreements as collateral with a bank to borrow money based on those subscription agreements before you actually call the capital from your investors. So here's where the more of like the logistical advantage of that is, again, if you're doing a lot of closings, buying assets throughout the year, your investors don't want to have to send money in once a month. That's a lot of work. You're putting a lot of pressure on them. And so you can better organize your capital calls. So maybe you're going to do one capital call a year or two capital calls a year, but you could be making acquisitions. And when you need the money, you just go to the bank and say, I need a couple $1 million for this acquisition. And I'm going to pull that based on here's all my signed subscription agreements. They go through them, they review them. These are all good. Here's the money. You haven't called
that makes sense.
You haven't called capital from that investor, so they're not accruing that preferred return just yet. So that's the So the downside is the investor isn't accruing a preferred return, but they also still have their money. So they still have their capital. They haven't made the investment. So it sort of makes sense. It depends on the opinion. But what the other artifact of all of this is that it shortens the investment time period. So like, let's say that, you have a 5-year investment period, plus or minus what you tell everybody. You spend the first year buying assets with your subscription line, and then you call the capital like after the end of that first year, and you pay your subscription line off, plus interest, obviously. There's it's not free money. There's interest tagged onto it. The clock then starts ticking. So then all of a sudden, the whole period is really over 4 years and not 5 years. And since internal rate of return, or IRR, is a time-based metric, that internal rate of return will appear much higher than it would be if the capital was called at the beginning of the investment. Now, they're going to get the same amount of money back. Like, in fact, maybe a little bit less because of the interest from the subscription line. But it was easier because they only had to make one capital. They only had to send their money in once instead of multiple times. And when they get their money back, they see a big number on the IRR, and it sounds good. But now you look at the equity multiple, that's not going to change. You either got a 2x or you didn't. You either doubled your money or you didn't. So it can be a tool that can be, so like for example,
not as bad as I thought it was. I'll tell you that.
But so, I mean, it could be used to artificially inflate, returns. But it's not necessarily to the detriment of the LP, unless that LP He's like, I want my money to be working. And that's where it can be sticky. And that's where you just need to be really clear and communicate with your investor. This is the plan. For example, we're going to be launching a preferred equity fund. We're doing some preferred equity deals right now. We'll most likely utilize a subscription line of credit because we have to move relatively quickly on some of these transactions, maybe within 30 days or so. That's maybe not enough time to say, hey, investors, we need you to send our money. I mean, it is. But again, if we're doing a couple transactions on a month, we don't have to say, hey, we're going to call your month. We're going to need to do a capital call this week, and then 2 weeks from now, we're going to do another capital call to find another deal. Instead, it's like, why don't you do a quarterly capital call?
Yeah.
You do all your transactions, you buy your deals using your subscription line of credit. And then once you hit to that quarter or halfway through the year, at the end of the year, then you make the capital call, bring the money in, pay the subscription line off. Okay.
So that makes a lot of sense because the implication that I was reading in the article, was this. So they're saying that it inflates returns and it's almost like, is it artificially? But it's not really artificial because the money's in their bank. They can use it whenever they want.
It is. Now, an investor may say, well, I have to keep that money liquid. So, I'm not going to make a big investment, or I put in the stock market.
You already put that subscription agreement. You're not going to touch that money.
You shouldn't, because then you're going to get the capital call and you have to have the money. So like it is, it is like you can make the IRR higher than it would have been without the subscription agreement.
Yeah.
But again, it's another form of leverage. I mean, it's not like you're saying, well, you're going to use a loan on this property and the return is going to be higher because you're using additional leverage. Like, sure.
It's not as false. It could be misleading or like lead to misunderstanding, but I agree. Like it's just the math that is giving this IRR. There's nothing that is necessarily misrepresenting what it would be.
I mean, like for example, I mean, question of is it above board or not? I mean, so I was talking about, I'm on the Indiana University Real Estate Advisory Board. And Indiana University has a private equity club, and it's really cool. Different students are in this every single year. It's only made up of juniors and seniors, but they actually raise money and they go out and buy. It's a fund. They invest in other people's deals, but they raise money from like alumni and stuff, and they go out and make allocations. They use a subscription line of credit also.
Oh, interesting.
And so it's like the universities are teaching. This is like major institutions. This is what they do.
Well, and I wonder too, if you do have a clear schedule of capital calls, then that idea that you have to like keep that money, safe. If you're expecting it to be called in June and in December or whatever, then you can use that money and then you just put it back when the due date comes.
The key here is communicate. If this is all communicated to your investors, it's all good because everyone is aware of it and knows exactly what the plan is. If it's done, behind the scenes, then that's when it's like, hey, look, I signed this subscription agreement a year ago. You haven't called my capital. What's going on? Yeah. And then, that eventually gets called and all is good. But communication is key, like in all cases.
Okay.
And so, I think we're seeing them more. Perhaps I think that because I think it is a very useful tool for GPs in a fund because you're not when someone signs a subscription agreement, almost always they're making they're contributing the money. Occasionally though, you'll have an LP where it's like I haven't been able to get a hold of them. They signed the subscription agreement. I mean, I've only had one time where someone didn't actually contribute the capital and.
I just pulled up this article that talked about the growth of the sublines of credit.
Good.
Yeah, and there's I think a graph here.
Yeah. It makes sense.
And what also is interesting is they have this breakdown of venture capital. It doesn't seem like much people use sublines of credit there, but for buyouts, people are using subscription lines of credit for especially real estate and then debt. But this idea, even if you even have a fund for like buyouts of companies, well, you haven't done the buyouts yet, and so there's all sorts of needs. It seems like for these investment funds that they may. It's not just buying real estate.
Just like other forms of leverage, it's a tool. Yep. And it can be used appropriately or inappropriately. There's a cost associated with it. It's not free, but it can effectively increase one's perceived return from an IRR perspective, not from an overall like return on or of capital from like a multiple standpoint.
And even kind of extending that to the broader world of private lending, it does seem like there is room a little bit for negotiation. You can always walk away from the private lender, but less so than maybe the bank. The banks is like kind of take. I mean, yes, there is.
What do you mean? In what context?
Well, like, so let's say you're getting a loan with a bank, and there is there is room to negotiate, but it is a little bit more of like a take it or leave it kind of thing. But when you're in the world of private lending, there's a little bit more options, and you can kind of leave it and then go to the bank. There's another alternative. But I also think, like,
some people don't think you can negotiate with banks. You definitely can negotiate with banks.
Yeah. And that is interesting. And we've talked about this before. If you're asking for a big enough loan, then their eyes are going to light up.
It doesn't hurt to ask. And they may say, like, no, we can't do that.
Yeah.
But it doesn't hurt to ask. Even Fannie and Freddie, it's like, well, we've got our form, we've got our template, here's the box, they can make exceptions. They make exceptions. They have to be in the box until they don't.
So my point was,
end of the day, it's people doing business with people.
Yeah.
Still bank,
and that's
federal agency.
That's what I'm kind of trying to get at, clumsily enough, is that so let's say the bank loans you X amount of money, you need just a little bit more. So you go to a private lender, and they, and then they're like, well, what interest rate will work for you? What interest rate works for you? And increasingly, because interest rates are already so high, that threshold is, people, well, I wouldn't have been able to swallow this 3 years ago, but now, all right, well, maybe it's an option.
Yeah.
And so I don't think that these, I don't think that, like, private lenders have borrowers cornered in any way. I think it is like a tool. Now, there's opportunities.
But also, I mean, like, the only difference between a bank and a private lender is banks just have some more rules attached to them.
Yeah.
That's it.
Okay.
I mean, they can be the same type of people. The terms can be often the terms are the exact same.
Oh, really? Interesting.
We're very similar.
Yeah.
A debt fund, which is a private lender, or a bank giving a bank loan, which is just like they're writing it on their own paper.
Yeah.
Like, they're just two different companies. Just the bank has more regulations. And so they have some boxes that they have to stay within, and they maybe cannot be as flexible. But at the end of the day, I mean, the terms can be very similar.
I have a question.
Yeah.
What is the typical premium ballpark for going private lending versus going for a bank for the multifamily space? And I know it depends on so many things, but I'm just wondering how much more.
I haven't looked at debt fund pricing in a while, because we don't usually go that route. Not much.
Yeah. Not
tens of basis points.
Oh, wow. Really?
Yeah.
Okay.
I mean, because they're not going to be competitive. They have to be competitive enough.
Yeah.
But banks, they also, they need to get a decent return.
Yeah. They have their own spread.
And I'm not necessarily talking about Fannie and Freddie. I'm more talking about like a bank loan where the bank is writing it on their own paper. They may be securitizing parts of it out or selling tranches of the loan. They often do, but they have a decent amount of flexibility, especially if they hold on to certain tranches of the loan itself. They have some flexibility on how they underwrite and the terms they can offer.
Okay.
And they have more flexibility than I think most people think. And again, I've been in deals with people who we're getting a bank loan and didn't negotiate anything. Yeah. And you can definitely negotiate now, but again, if it's like there's certain cases where they can't, or areas that they are more restricted on, like if they are going to securitize the loan, then they do have to fit into a certain box, and so there are some non-negotiables. But if it's not being securitized, if it's being held in their portfolio as a portfolio loan in the bank, they can be relatively flexible. Maybe they don't want to be. Yeah. That comes down to the relationship.
Okay, that's really interesting.
But some people don't know you can negotiate with the bank or go to the other bank. Yeah. Different banks will give you different terms. Point, yeah. And so if one bank can give one set of terms, another bank can give a different set of terms, it's not like there's some rule. They're just businesses making decisions.
Yeah.
They're not, they've got a charter or something, but they're not wholly entities.
Yeah. It's just interesting how many options, and we've talked about this in December of last year. But how many options are emerging because of the high interest rates? And
yeah, no, and people are looking for options, and especially in when people's backs are against the wall, they're looking for money, wherever they can find it.
Yeah.
Matt, where would you like to go to next? You like to go to the Integra Realty Report, the IRR report?
Oh, yeah.
Speaking of IRRs.
I know. I thought, what a great name. I already kind of teased this report by excerpting from the letter from their CEO, which was pretty persuasive and compelling in its own right. But I think that I think that this has really good data throughout it, and we're not going to be able to cover everything, not by a long shot. Very, very quotable preamble again. And I also like that they have they've really taken on timing as this big theme for this year. And it really has become excruciatingly clear how important it can be to calculate time and the time value of money, the idea that you can spend some money today and owe more money tomorrow, and finding that sweet spot for, just like we said, negotiating with a private or a not private lender. This seems like it's getting more common in the world of uncertain and elevated interest rates, and maybe it's worth it to pay up for this finite period of time to keep a deal alive, and it's in this time of high interest rates where it may come down, where it's worth maybe considering the alternatives, and you can really figure out the percentages and time periods that work best. So just kind of starting out, there is coverage of the economy, and then we can maybe dive in a little bit to multifamily markets. But for their economy, very similar. Similar comments on the uncertainty. Definitely land on the optimistic side of the coin. But when it comes to inflation, they are covering the general trend of lowering inflation. But I did appreciate their attention to how prices are moving. And they talk about the labor shortage. And one of the things that you were mentioning is, yes, productivity is going up. They are raising the possibility of retiring baby boomers, and that could be a real shift for income growth, for productivity, for labor shortages, et cetera.
This is the labor force.
Yeah,
hard hats.
One of the articles that I didn't have time to include, I just kind of came across is, all these CEOs, the baby boomer CEOs are moving out, new blood's moving in. So there's some like leadership shifts that are going to occur too. But to return to inflation, yes, they covered that general trend of it's going down, but I appreciated their attention to how different regions and locations, how prices are shaking out differently. Specifically, inflation has been higher in the Sun Belt compared to the Boston-Washington corridor and the Midwest. Well, it's kind of interesting that the Midwest and the Northeast are the apartment markets with the strongest rent growth. That kind of show you maybe how high housing prices are linked to cost of living.
Well, it's so interesting because it's one of the reasons why the Midwest is seeing rising rent prices and so much housing demand and just progress is how affordable it is.
And
the prices are so low that you can just overall cost of living is low. So it's a good place to live. Now, some of these other Sunbelt markets may be more desirable and seeing more demand, but they're so expensive, so it's not exactly an option for too many people.
Yeah, I've been thinking, and that's one of the other things I was thinking we'll see it in this multifamily specific report, was this idea of like a ceiling of affordability and like a floor of demand that we're running against. One of the things I noticed was we've covered this report in the past.
Yeah.
I think we covered it maybe in like 2020 or 2021. And one thing I noticed was their graph of the market cycle, this little wheel they have between the stages of recovery, expansion. No, that was there. It was
I thought that was the office.
That is for office. Sorry, I'm getting screwed up here. But they have this wheel of the multifamily market cycle that moves from expansion to hyper supply to recover, or to recession, and then to recovery. Now, expansion is characterized by different levels of different levels of demand and supply, but they have all these markets along along this. I'm guessing it's like a life cycle or something. I thought it was kind of interesting. In the hyper supply category, we have a lot of these Midwestern markets that are experiencing a lot of rent growth, and I haven't noticed that they're getting a lot of new supply in the future.
I mean, they are getting, everyone's getting a decent amount of supply, more relative to the past.
Yeah.
I mean, Indianapolis in the Midwest, I mean, the new deliveries relative to existing inventory is, in the 5 to 7% range, depending on the market. It's usually in like the 3 to 4% range. So it's definitely higher, but it's not like 9 or 10 or 12 like the Sun Belt.
Yeah.
So, I mean, there is definitely new supply coming online. It's just not nearly what it is like in some of the actual hyper supply markets and the markets that have even gone past that.
That's interesting. Just for their definitions of like what hyper supply is and what this recession and recovery, they define expansion as decreasing vacancy rates, moderate to high new construction, also high absorption, high employment growth, and high rent growth. Hyper supply is increasing vacancy, high construction, low absorption, moderate to low employment growth, and medium to low rent rate growth. I think that, that's not what I'm necessarily seeing in places like Cincinnati or Indianapolis.
I mean,
I
would put even, I don't think it's wrong. I mean, I would say that it's on the moderate, like on the absorption. It's definitely low or negative. I mean, absorption in a lot of markets in the Midwest has been low or negative. The supply hasn't been as much, so we still have some rent growth. The employment growth has been moderate. It's not been low, and the rental rate growth has been medium low. It's not been negative. And that's where in the recession, it says actual negative rent growth, where I think, I honestly think there should be more markets in the recession category.
And it is worth mentioning that by far the biggest group of markets are grouped in the hyper supply section. But I wonder, how, I'm not sure if this is going to move, if these markets are going to move linearly, if it's always moves in a like clockwise direction. It could go from hypersupply to expansion, or from recession to hypersupply, or whatever, depending on what moves these the apartment developers make, and how population growth and job growth shakes out. There could be a little bit different shifts here. I'm not wholly convinced, especially considering they called out the Washington-Boston corridor in the earlier commentary, and that's
what do they call them out for?
They called it out for low cost of living, and I
wouldn't call that an area low cost of living.
Well, yeah, I mean inflation. What did they?
I would not call the Boston low cost of living.
Well, they did say, DC. But they did say that inflation has been lower. It's maybe the ground, But
yeah, well, inflation's been lower in San Francisco too. It's still expensive.
Yeah.
It's all relative, Matt.
Yeah,
it's all relative.
But
that's what that chart misses.
That's true. That's true. And they do talk about affordability issues too that are coming to favor Class B units.
You don't want to talk about the cap rates?
Oh yeah. Let's see. You think that what they have
is accurate?
I don't think they have their projections, but they definitely have a prevailing cap rate for these markets. I would be interested to see what your opinion is.
I think that it's more or less maybe correct. I mean, based in the South, CBD Class A at a 5.35 cap. Sure, I think that could possibly be correct. It's gone up 70 bips, 58 bips on the suburban Class A at a 5.5 cap. Because these deals were trading for 4 caps, 3.5 caps a couple years ago. Again, they don't even have like the Midwest, right? The central region, just the rest of the country besides the East Coast, the West Coast, and the South. Anyway, that's fine. Suburban Class B. 6.83. I think that's where things should be. I don't think that's exactly where things are, though.
What does the discount rate mean?
I'm not sure how they're using the discount rate.
So yeah, it's what do they? So the movement here.
It could be when they're like their MPV calculation, but
okay. So I do think it's interesting. Across the board, cap rates have gone up from 22 to 23. But the most that any of these cap rates have gone up is, maybe like 83 basis points, which sounds like kind of a lot, but I'm positive that interest rates have gone up way more than that from that period. So we are still in a situation where interest rates are high, cap rates are not as much as they've gone up. They have not gone up enough. And I think that the market is keenly aware of that. And there was an article just last week that posed the question of like, are investors going to dip out of the multifamily investment market because interest rates and sluggish capital markets and low cap rates? It just doesn't make it really fun to invest right now.
Yeah,
but we'll see. And speaking of transactions,
I don't think that's going to be the case.
Oh, I don't think so either. I think that there is enough. People have been wooed and charmed by the benefits of multifamily investing over the past 3 years. Too much,
and that's the exact type of language that I'd be looking for to invest. Is if you have some professional advisors, or somebody. Once people start saying something, you want to start steering away. It might be a time to start looking at it.
Totally.
In a sense. Or it's not even saying to steer away. If they're saying that some investors may be looking the other way because something else.
Yeah.
I mean, if the long-term fundamentals make sense, which they really do in multifamily, it could be the buying opportunity. And that's what we've been saying right now. It's like prices are down.
Yeah.
Like prices are down. And your basis and entry point is so important. Yeah, the leverage is important, but your basis is more important.
Yeah.
Way more important. And you're getting good basis right now. And you have to be able to be willing to take more risk, but it is a slightly higher risk, but potentially higher return scenario that we're looking at.
Yeah. So, I was mentioning slow capital markets activity, and this map here shows for, the top markets for multifamily transactions. And there's a whole lot of them that are down. Most of them, nearly all of them maybe have gone down. Although New Haven, Milwaukee, and Cincinnati are in the positive. Cincinnati, their multifamily transactions increased by 1.7%. Milwaukee, the transactions increased by 6.4%, and in New Haven, 43.2% increase.
Somebody bought a half of the apartments.
I guess so.
I don't know how big New Haven is.
But the next one after these top three is the negatives, which goes from Des Moines at negative 11.1% all the way to Detroit at negative 88.6%. So, man, virtually everywhere has their transactions down by almost more than half. Some of these, it's down by 90%. Now, we're not talking like that means it's cut in half. That means that the remaining transactions are only a sliver of what they were. But yeah, we can if you'd like to speak about multifamily, maybe more specifically in the apartment list report, there's a little bit more information on the fundamentals.
I love the apartment list reports. It's just straight down to the data.
That's right.
Let's jump right into it, Matt.
All right, and I've got some. There's a couple references to a few other reports that came across this week. And if you're a subscriber to the Gray Report newsletter, you will have these already in your inbox. These reports, links to the reports from Yardi Matrix and RealPage, but I'm using the apartment list as a jumping off report. And I did mention it last week, not as an intentional teaser. So it's worth discussing here. I think that what also could explain the numbers from apartment list is this kind of idea of seasonal rent decline. But what I mentioned last week was that the monthly decreases, so these seasonal rent declines in 2022 were slightly stronger than the seasonal rent declines that we're seeing currently. It's not by much, but it is enough. And it's the fact that it is going down that's a good sign for rent growth for multifamily investors in general. And I think it's a sign of a further normalization and less of, I don't think that we're spiraling out towards a bad outcome. And
we've inverted our periods on our cycles.
Yeah, it does. Yeah.
Between positive and negative. I mean, typically the first, half of the year or more is, the peak leasing season. You're getting more rent growth. And then, once you get, Thanksgiving, people are in school, rents decline. People are trying to get units filled up before things get cold in winter. typically make some concessions. That's what you see, 2018, 2019, those are our normal years. And then everything's messed up after that.
Yeah.
But even in 2022, you started seeing a little bit of normalization, with strong rent growth in the first half with, some big negative declines in the second half. But then 2023 was just weak sauce, very tepid growth. And then, some relatively substantial declines, not as much as in 2022, but we didn't have any of the gains that kind of averaged it out.
A weaker summer. Yeah. So it really just hurt. And it has led to what is overall, what's their year over year number? They have, well, I got their month over month number, which is 0.8, and shouldn't that count for something? I think that we're it's definitely negative. It's about negative 0.7% is the total number for 2023. They call that the second weakest year of rent growth in their reckoning out. Now it only goes back to 2017, but it's still it's still
it's good.
It's better than it's an improvement from the lows of 2020, which was negative 1.3%. Now, as a kind of caveat or counterexample to this picture from Apartment List, Yardi Matrix did record negative rents, but it was closer to like 0.2% rather than 1.3%. And also, both Yardi Matrix and a recent report from RealPage mentions kind of like a backstop of apartment demand that has really supported the market amidst this supply boom. And something that I'm glad that RealPage, and I'll include a link to that in the show notes. Yeah. But I'm glad that RealPage noted that things could have been worse, and even in the Apartment List, we're looking at the vacancy index. Things are leveling off when it comes to.
Yeah, they're really more It seems like they're really normalizing.
Yeah, and it may still be slightly above, what their historical average is.
It probably will. It'll probably keep rising a little bit before it comes back down.
But again, like this is in the context of the greatest surge in apartment supply in decades.
Yeah,
and like a generation or more. So I think that's definitely worth. And I'm just going to read.
This chart makes a little more sense to me now with red is a lot of growth.
Yeah.
I always am confused. Look at this chart every week.
I think every
month.
Each of those rectangles is a market, right? Maybe?
Yeah.
Okay. And so each vertical stripe is a month.
It's a month.
Oh, all right. Okay.
And then it's blue is cold, red is hot. So,
all right.
Every time that we're like, this chart makes no sense, because Matt and I have repeatedly been like, well, what is this? This like color
mosaic.
Mosaic. And the people at Apartment List are like, it is not that complicated, actually. It's kind of cool. But I mean, this is some pretty. I mean, that's a lot of growth. And then just see how there's no color. There's like no. It's winter. This is like the heat. This is like we're on the surface of Mercury or Venus, and now we're down over in Neptune land over here. It's frosty.
Yeah.
Multifamily winter 2023.
It's true, but again, to kind of like push back against it a little bit.
Yeah,
there is this thought from RealPage. I'll just read the quote there from that article in question. He says, Carl Whitaker says demand should be boosted by strong wage growth and a prolonged renter life cycle due to less attrition to single-family housing due to limited available inventory, among other factors. Supply will make the main deterrents for market-level rent growth. We talked about that, and even rent growth at the national level. But from that perspective, expect a close one-to-one relationship where higher supply equals weaker rent growth, lower supply is stronger rent growth, and in lieu of rent growth, things that will likely fuel much of the 2024 outlook will be focused on occupancy through means of modest new lease rent growth and increased emphasis on retention. Those are, we've talked about that, buckle down. This is a time. I was about to say like these are the times that Tryman sold or something, and there was some language like that in the Integra viewpoint where they were like, it was like this, these will be, what is it, separate the men from the boys, that kind of like we'll now know. Or what is it, the Warren Buffett quote about like wearing a bathing suit when the tide comes out or something. But like,
or see who's naked.
Yeah, I do think, masculine tropes notwithstanding, there is like this, there is this sense, and I think that we definitely have been talking about it, of like, well, we're finding out and we're learning every single day about the sponsors and the operators that were coasting on easy money and an easy rent growth. And now that like
or they just started playing the game at the wrong time. And the music stopped and they they didn't have anything to fall back on.
Yeah. But I do think, kind of to return to this idea, it is worth highlighting the resilience on the demand side. And they're kind of, and like I said, maybe there's an affordability ceiling, but there is this, call it floor or a backstop. I like to picture those padded walls underneath the basketball goals in grade school. There's a little bit of a soft, there's enough demand where you're not going to run into the concrete.
Like in an insane asylum.
Yeah, or maybe an insane asylum. That's probably a closer metaphor.
Can't hurt yourself that much.
Yeah. So we're not looking at disaster. And even when we were looking at that mosaic of, what looked like a winter, it wasn't too much different from 2019. There's some blue areas and some red areas.
Yeah, there's usually some months of growth, and then some months of decline or slowdown. And typically, the industry has not been one of big organic rent growth. It's been $25 here or there, unless you're going to do a big value add.
And with that in mind, I do, if you look at it over this longer 5 to 8 year period, we will look back and see the huge rent increases in 2022 as this huge anomaly that was never really even normalized as much as you'd think. You'd think there would be a counter adjustment so much more for how much rent growth we saw in 2022. We should be maybe seeing a lot more of a crash, but it is because I think that there is a little bit of a shift in the value of a home that is way stronger.
Getting back to affordability, I mean, you can't go buy a home. So many more people are renting. And I think it's a good point. I think it could be, the correction could be more severe and deeper. I don't think we're done with the correction. I mean, it reverts to the mean or close to it. I mean, the mean can increase, of where your bias is. It can move up and down. There's some correction that's been going on. Just how much more do we have to go through it? But I think it's a really good point. Just seeing this incredible growth of, having months. We had months that were close to 3% rent growth when you said rent growth 3% in maybe a year. So we haven't seen any declines that are near 3% in a month. So it's a good point, and it underlines the demand that is out there. And like the Sun Belt, for example, is experiencing incredible amounts of demand. But there's just so much supply that the rents are going down.
And that was another thing that the Integra report noted is and I may have even said is over these longer time periods that are typical for for CRE investors, you may not need to worry about a recession, because that may last maybe 10 months on average is what they said. And if you're holding it for 5 to 8 years or however long that is, that's a lot longer. And so keep your eye on the longer term prospects, like maybe what the IU professor said is the fundamentals of the economy may be a little bit stronger than what people think. And I
think we have a negative doom bias.
I think so too. Yeah, we were trained. I think at least in my, and again, this is me coming up during the Great Recession, but I was trained.
Things always get bad.
Yeah,
markets crash. That's what happens. No, I remember for a while before I really got into when I just started getting into investing, I thought the stock market usually went down.
Yeah.
But it's not the case. The stock market usually goes up. And it just highlights what our biases are towards negative events, because we fear the pain more than we appreciate the gain.
Yeah. What is going to be interesting is what the story of inflation is going to be. So let's say we do wind down inflation. I wonder how much of what were the real drivers of pandemic inflation if it wasn't purely the Federal Reserve lowering interest rates and also the stimulus. So those two things, maybe. But how much of these external factors being resolved, whether it's, cargo ships stuck in the...
Well, I mean, it was a confluence of things, right?
Yeah.
It was supply bottlenecks plus demand surges, but a shift from demand of services to demand of goods.
Yeah.
Combined with those supply bottlenecks, and then money printing and zero interest rates, which made the money free so that we could buy more stuff and pay for more things, and then that's catching up to us. So, I mean, it was a confluence.
And it's just thinking like, okay, so all those things, they're not happening in the same way that they were before. So there is also room to maybe think that inflation will continue to go down. There are geopolitical things, I think, that could keep like energy prices up or something, or even
I think it's going to be. I mean, we could be setting ourselves up to a pretty sweet scenario of. I mean, inflation at 3% is not the worst thing. I mean, again, like before now. Pre-pandemic, there was a lot of talk of, should 3% be the inflation target, not 2%? Is 3% okay?
I think
why does the target have to be 2%? 3's not that crazy. We've been wanting higher GDP for so long, so we can, inflate the debt away and get some positive growth. If it's not run away and it's stable, all we need is stability. We don't want stability at 10% or whatever. But even if we knew it was 10%, then that's what we would plan on. So if we're at 3%, I think that's okay. I think we are going to still see labor shortages. I think there are going to be enough inflationary pressures that are going to keep things slightly elevated, but it's not going to be, run away by any means.
The only X factor in, and it maybe is almost a certainty, is how excited is the market going to be the second the Fed does their first rate cut. If they pull out on a bonanza,
just what I did when Powell suggested it.
Yeah. So that
it's probably market's gonna go down.
Yeah, the reaction, but even though maybe the stock market and the pricing in interest rates that are not even likely to arrive, they're ready to celebrate it at a moment's notice. But I do feel like in the multifamily market, there hasn't been as much excitement about interest rate decreases as their capital markets
activity. Giving people hope.
It's giving people hope, but we aren't seeing a huge.
You can't lend on a press conference.
Yeah, and that's what I'm kind of thinking.
Can borrow. Well, in a couple months, maybe they're going to lower the Fed funds rate.
There's a little bit more. Yeah, it seems a little bit more disciplined. Although there's always room for what is it? What are they called?
But the effect is, but it allows the banks to kick the can down the road.
Yeah,
saying, look, the Federal Reserve has indicated they're going to do 3 rate cuts in 2024, and you know what, Mr. Borrower, we're going to give you another extension because if that happens, we don't want to foreclose on your property, and we'd rather keep you as a customer, and it's a good asset, and you've been a decent manager enough. So I think that's the how that trickles into real time, but it's not necessarily reality, and helps on the margins. Again, like the marginal borrower and owner that's going to happen.
Well, and what I also was kind of what I was really thinking about too is and you're gonna have to let me know what the what the word is on the street at the NMHC conference. But are people are people getting ready to buy aggressively, even at the current interest rate environment, or are they going to? Well, we're kind of waiting for things to actually happen before, we can't do this on a rumor.
People are always very macho at NMHC. They're going to all be like, oh, we're going to be, yeah.
Oh, that's funny. Okay, you got to translate there.
Oh,
that's funny.
Yeah, it's a whole thing.
Oh yeah, I don't know, and maybe it is hard to separate this kind of bravado with the actual decisions. Their kind of spreadsheets are in front of them and they're actually kind of signing on the dotted line. But my assumption is
some of these guys don't care.
Yeah. Okay. All right. Because I don't know. I thought maybe it'd be more reasonable that would be
some of them.
We're gonna hold off to real things, but all right.
Some of them. Or you talk about in talking to people individually. Some of them most folks seem very reasonable. Some not as much. And again, because I'm just thinking the problems we're seeing in multifamily, like I saw it coming because I've been having conversations past NMHC's, the National Multifamily Housing Council's annual meeting that takes place at the end of January. People just bragging about how crappy a deal they just loaned on, how much leverage they got on some horrible deal.
Yeah. It puts things into perspective, I guess.
It's like, this isn't that excited. This is not good.
Yeah.
It's a great event. It's a lot of great people. But there's definitely some aggressive folks out there.
Yeah, and we probably mentioned
some you may think are not aggressive. You see them on LinkedIn or wherever, but they're making some interesting decisions.
I'd rather be that kind of person. You don't see me coming, and then you're making the deals. But maybe there's a little more clout you get if people think that you're throwing your weight around all the time.
Yeah, it's some kind of measuring contest. Yeah, it's interesting. Although it'll be very interesting because I could see it as more of a year of austerity of like, well, people are pulling back, because usually, all the brokerage and the lenders, they throw in these huge, parties and dinners and all of that.
Yeah.
And I'm curious to see if the budgets got cut.
What was it like? What was it like last year?
And it was in Vegas last year.
Well, okay, all right. So you can't not do it up in Vegas.
Yeah, but it was also in January of 2022 when things were still
they were running off.
Things were still good,
Momentum
and rates had come down a little. It was funny. It was like rates had come down a little, like the 10-year treasury had come down a little bit, and people were like, "Well, rates have come down a little bit." And I was like, "Okay," and then literally like a month later, it was like,
fine.
So stick around. No, maybe maybe I'll do a little live broadcast from NMHC.
Yeah, that would be delightful.
A little live stream.
Yeah.
It'll be fun. Walk around. Okay, Matt, this is a great episode. Make sure you like and subscribe. Press the bell icon if you want to get more updates because we're doing this every week, trying to keep you up to speed because, the person with the best information typically is pretty successful in life, Matt.
That's right.
And have to have a decent chart to be able to navigate these rough waters.
Oh, yeah.
So trying to plot some good courses.
We're giving you binoculars where other people are giving you blindfolds.
We're providing the sextant.
Okay, all right, good. That's even better.
Yeah, we not only want to see, but we want to be able to navigate.
Good. I love it.
All right, thanks again for tuning into The Gray Report. We will catch you later on next week's episode. And hop on over to Gray Capital LLC, especially if you're an accredited investor. Check out our newest and latest opportunities. All right, see you.